You're welcome to another edition of the Fintech Open House by the Payment Log. And this September edition, we are going to be talking about the credit infrastructure in Nigeria. I'm very, very pleased and honored to be joined by Nifemi Oluboide and Temitope Akinremi. So I would give them an opportunity to introduce themselves, but I just want to talk about what we do at the Payment Log, especially with the Fintech Open House. So Fintech is growing astronomically in Nigeria and in Africa at large. And there are conversations that people need to have. I'm very, very pleased. There are conversations that people need to have that cannot be had in silos, right? And these are the kind of conversations that we are facilitating at the Fintech Open House. So we've had various conversations, like conversations on the payment rails, conversations on the operations of fintech. And today we'll be discussing something that is very interesting and a growing part of fintech, which is credit or lending. And I'll be joined by our very experienced panelists. So just to give a structure to the conversation, we would first of all start with introductions. They will tell us what they do, especially as related to the credit infrastructure that we're talking about, an opportunity to, and we will also discuss, talk about what we do at the Payment Log, especially with the Fintech Open House. So Fintech, and I think you need to mute yourself. Thank you. Okay, so let's hope that it sorts that out. So I was talking about a scope for our discussion, right? We would start off with introductions and also try and establish definitions of a lot of the terminology that we hear bandied around. And then we'll jump straight into the conversation and see what we can cover before our time elapses. Nifemi, is that fine? Is that approach okay? Right. So I'll start first with you, Nifemi. Please introduce yourself.
Okay, hi everyone, good evening. My name is Nifemi Oluboede. I happen to work as a product manager. I've done that for a few years, but beyond that, I think over time, I think I've accepted the name Fintech Bro, which is like my Twitter name. But pretty much I've spent the last 7 years thereabout in financial services, done stuff with Zenith Bank, did stuff with System Specs, Remita, TMAT, Carbon, Fairmoney, doing a bunch of stuff with Woodcore at the moment as an advisor, also working on a digital banking project right now, and also trying to build a buy now, pay later business. So yeah, that's like in a very, very small nutshell.
The name Fintech Bro really suits you. I agree with them. So let's go to Tope. Tope, please introduce yourself.
Right. So my name is Tope Akinremi. I lead product and customer success at Indocina. Before Indocina, I was at Andela, where I was a product manager, and before that, Deal Day, where I held different roles. Currently, at Indocina, what we do is we offer technology solutions that empower businesses to offer credit to their own customers, in a faster, more secure and scalable fashion. We have two products out in the market. There is Decide, which is a bank statement analysis engine that uses ML to enable businesses get smarter about financial transactions of their customers, while Originate, our lending management software, automates the lending operations for lenders, from origination to data aggregation, credit decision, disbursement and collection. Plus, we also build credit models for our clients as well. Happy to be here, and thank you for having me, Payment Log.
Thank you very much. That's very interesting. If you hadn't mentioned Decide, I was going to ask you about it, but thankfully you explained what that is. I was very curious about that product. So we'll jump right in, and then we'll go to definitions. So a lot of people talk about or hear about credit infrastructure, lending, buy now, pay later. What do all those things mean? What modules are involved, and who are the players? Nifemi.
Okay, thanks a lot for the question. So I think I'll start with credit infrastructure, and I'll try to explain that in the way I've come to understand it, right? For credit to happen, I see that there are a lot of players that, come into play, right? Whether they're the players that you see on the surface or they're players that are enabling stuff at the background. However, identifying those smaller subsets of the entire scope is what makes up that infrastructure. So, you're talking about financial institutions, right, or lenders, which you can break down into, bank and non-bank financial institutions. Then you're taking a step further to look at, data source providers like the credit bureaus, alternate data sources like, the guys who now provide us with open APIs, Okra, Mono, my bank statements. You're also looking at alternate data sources like providers of payroll data, provider of telco data. So I think it's a myriad of small facets that now come together to form what we can call that, credit infrastructure. I don't know if Tokwe has anything to add before I talk about the other things you mentioned.
Top, do you have anything to add?
Yeah, just to add, he's mentioned some of the players in the space, but when after that lender or that business has decided that they want to give a loan, there's also infrastructure to to disburse the loan. We have the payment gateways, Flutterwave, Paystack that can disburse the loan to you, and there's infrastructure as well to collect back that loan, because of course they want to get back their money.
Very important.
Very, very important, actually. There's card-based collections, Paystack and Flutterwave, are powering that right now. We also have account-based collections. Nifemi mentioned Remita earlier. He also mentioned Okra and Uno that are doing, account-based collections for in the credit space. But then we also have, those guys, collection agencies. When the loan goes into default, sometimes lenders want to employ these agencies to collect on their behalf. One player that I know of right now is called P3. They say they're an ethical collections agency.
It was good you mentioned ethical, because later on we would explore how there are lots of collection methods that are, unethical. But let's delve more into the subject matter, right? There are different kinds of loans or different kinds of credits, and I want to group them broadly into business credit, and they have their various kind of products, and also consumer loans or consumer credit. Can we talk a bit about those? Temitope, what do we have to say about business credit?
Right. So, business credit you would term it more SME financing. We have businesses, lenders who focus more on giving loans to small businesses. Small businesses power our economy. I think the thing lenders usually would want to look for with lending to small businesses is because, the money that comes in their financial transactions are not exactly very structured. Like with a salary earner, where you can bet against a steady amount that comes in. So, when a lender is looking at an SME that they want to lend to, they're mostly interested in the cash flow. How much money is going in, coming into that account, how much money is going out, and primarily, what is the spending on? Is this person spending on the business or on frivolities, for example? And they're trying to get what is the average balance that is in that bank statement or in the financial transactions of that business that it can bet against in terms of collections.
Okay, I want to expand that thought a little bit more, because I think from what you said something very important, that small businesses power the economy. So Nifemi, I'll be directing this question to you, right? I think that the kind of lending we do in the sub-Saharan Africa, or maybe Nigeria to be specific, is quite elitist. It's too safe, and it's focused on a specific type kind of category. And if you don't fit into that category, nothing for you, right? But for SMEs, we have people that are moving companies in themselves, moving brands, and we even have institutions that sort of facilitate people creating their moving companies. They are referred to as influencers. Most people have left traditional type kind of markets, and even in fintech, to leverage these brands, to market their goods. And these people are bankable. The kind of credit we have today, how do you think they fit into that structure of providing this kind of people the credits that they need, since they are, an ongoing, and they are growing? The comedians XYZ, we can, name some names, but we don't have to. What do you think about business credit and this type of individuals?
Yeah, I do think that, to a large extent, before now, maybe if they had approached commercial banks, it may be a bit tricky, right? Because like Temitope mentioned, it's safer when you're giving out loans and you can beforehand assess that, okay, there's a steady amount of inflow that comes into this account at regular intervals, and it helps you to sort of project their affordability and their propensity to pay back. But what you then find is that in the more recent times, with the digital lenders that we now have in the space, in the last, say 5 years thereabouts, the likes of, Carbon, formerly Pay Later, the likes of Branch, the likes of Fair Money, the likes of Palm Credit, they've gone a step further, and a lot of the credit assessment that they now put into play is designed to support unstructured earnings, right? So as opposed to looking out for just salaries and all those things, there are a bunch of other information or data sets that they are consuming to make lending decision. They are leveraging all types of inflows. So like you said, this kind of people that have unstructured, yes, it may not be a regular interval earning, but, at a defined period, say maybe a 3-month period or a 6-month period, you can track the total inflows that come in based off of their behavior. You can, make some deductions. There are so I also like to sort of break down the different data sets that these digital lenders now make use of, right? Beyond bank statement, they're looking at things like, demography. They're looking at behavioral patterns. They're going further, than the regular bank transactions to even other smaller transactions like, airtime, bill payments. All these things help to sort of create some level of profiling for them. And at the end of the day, right, irrespective of the person's actual identity, based on the information that they have, they're able to then make lending decisions. So at the end of the day, everybody can get a loan, right? As long as you're not like a defaulter that has bad credit history, almost everybody can get a loan, no matter how small.
Okay, that was very comprehensive. Thank you. It looks like we moved from business, talking about business loans, into consumer loans. So I want to ask a question.
So what you find is there's a very thin line, between the SME loans and the individuals, because a large portion of these SMEs that we're even talking about is unstructured. So you find that a lot of their finances intertwine. They present their business accounts, you see that not much is happening there. By the time they present their personal accounts, you see that that's where the real bulk is coming. Let's not rat people out on this call, right? We know those who are looking out to pay stamp duty or all those small things. So yeah.
I agree with you, but just to focus the conversation. So lenders look at two things when they want to make decisions, right? They look at your capacity to pay, and they look at your willingness to pay. Please, could you shed more light on that, those two decision points?
Right. So those are basically, they represent two arms of, two things that lenders want to look at. Your capacity to pay really just looks at your financial transactions. How much comes into this person or to this bank account in this case, and how much goes out. How much is left behind when money goes out? What is the spend that goes out from this bank account? So that is a capacity to pay. How much capacity you have to repay that loan plus the interest that they're willing to charge, that lender is willing to charge on the loan. Then there is your willingness to pay. Willingness to pay is looking at your credit history. Have you taken loans in the past before, and have you repaid those loans? Were you ever in default before? How much default were you? So lenders look at your credit history to determine, okay, well, if this person has always been steady with loan repayments in the past, then this person is likely to be steady with loan repayments for me, for my own business now.
Awesome. So I'm coming in from that, right? Let's go into this very fancy and it's trending right now, this term they call buy now, pay later. What do you think about buy now, pay later and our growing e-commerce, our growing e-commerce ability to participate in buy now, pay later? What are your thoughts, Tope?
Yeah, so buy now, pay later, it has always been it has always been in existence. We've always had buy now, pay later. You could go to you could go to a bank, you could get a car. You could get a car, for example, a car loan. That's buy now, pay later. You could get an asset, for example, you buy a TV or a fridge. I've used buy now, pay later, at least asset financing, as they call it in the microfinance banks. To get a few gadgets and appliances in my house.
You've used it as a bank manager, or how did you get access to that kind of thing? I doubt that somebody on the road has access to that kind of resource.
Oh yeah. Well, the thing is, these banks already offer it. If you go to a microfinance bank now, I'm sure you can, walk to their front desk and tell them you want asset financing. And then they would ask you all the things that they need to ask you. They check your demography. They look through your bank statement to determine if you are, you're able to pay what you want to get. They look through your credit history to determine if you've paid loans back in the past. And then you eventually just send them a link. Usually they want to work with structured e-commerce services. I'm sure no lender wants to tell you to use Gigi, for example. So, you probably send them a link for that item on Jumia, on Konga, the popular e-commerce sites, and then they finance it for you. They pay to the e-commerce site, and then that stuff, what that gadget is delivered to you, and it's in your house. You can start to use it. What's happening now is that firstly, there are folks now building structures to aggregate these businesses that can offer credit in terms of assets, that can offer assets on credit to consumers. There are people now building businesses around that to aggregate all those businesses into one place and remove the friction that you as a consumer, you would remove the friction that you as a consumer would experience to be able to get that asset when you want it.
Okay, Nifemi, I'd like you to weigh in on that, but I want to take it through another turn. So as he was talking, I just felt left out, right? I don't have any credits of any sort, so I don't know. And I don't even know that people walk up to microfinance banks and ask them to help them buy TVs of, I don't know. This is the first time I'm hearing of it, right? And to a reasonable extent, I think I am bankable. I have the willingness to pay, I have the capacity to pay, but I'm sort of cut off from credits in Nigeria because I don't have access to these things. Looking at what is happening in Klarna and in Affirm in the West, right? Do you think those kind of things can be applicable to Nigerian consumers like myself? Because we want to access credit for shoes, bags, or whatever it is we want to buy.
So simple answer, I think yes. In fact, it's not, I think definitely yes. And I would say that no better time than now, right? Because if you look at the Nigerian market, two things have happened in the last, say, 2 years thereabout, or two specific sectors have grown and have started to, reach market acceptance. The e-commerce, definitely, we've seen how big Jumia got, and then lending, especially, uncollateralized, or the digital lending guys, as we call them, right? The likes of Carbon, the likes of Fairmoney, the likes of Branch We've seen how much, at least from what they're raising, right, you can tell that there's some level of validation, and even the numbers that they shoot out where, these guys are probably lending more than some commercial banks at the moment, right? And what that tells you is people are ready to buy online and people are ready to take credit. And if you match these two things together, that's like the intro to BNPL 101, right? When you have e-commerce and you have lending and you merge it together, either it's the same person providing it, either it's, two of these players in those spaces coming together, or somebody that is coming to sit in the middle to bring these two people together, BNPL can now start to happen. Like Temitope mentioned, right, that we've had it since, and I think in earlier conversations, I gave the example of bank staff that had always been writing checks, right? It's the same thing. What we can now start to see is, in fact, already started to happen, right? A lot of platforms are now saying, you can get gadgets on credits, come and pick up an iPhone, pay over the next 6 months, come and pick up a Samsung Curve TV, come pay over the next 4 to 6 months. And, I personally am also a testament to the fact that I'm almost certain that, BNPL is the way to go. Because if not, I won't be spending my nights on, building an amazing BNPL product that people will get to know about really soon. So yes, definitely. I can tell you for free that the market is ready. Opportunities are huge. And, barring any unforeseen regulatory brouhaha, it could possibly be the next big thing.
I like your optimism, but I will still delve further, right? So what makes products successful are things that already happen offline, and then you're sort of just using technology, to take them online. So people refer to them as digitizing trust centers. So that if market women contribute together in Esusu, I know your house, my daughter and your daughter, they go to the stream together, our sons hang out together, and you're owing me, I'll come and get you, right? The earlier conversation you had, or the earlier analogy you gave around the bank workers having access to credit, is as a bank worker, your check is not supposed to bounce. So there's somewhere we will catch you from. Other advanced economies have your social security number that is tied to your credit score, and everybody guards their credit score very jealously. If you're moving down to Asia, advanced economies or economies that are really trying, like the Indian economy, have the Aadhaar score. Nigeria, we don't have anything, and yet we are saying this thing will work, it will work, it will work. Please, how is it going to work?
So first and foremost, right, I would say that the Nigerian, should I call it the Nigerian tech space or the Nigerian fintech space, we thrive on circumvention, right? Put a challenge in front of us and
awesome.
You'll find that somebody has built a way around it. Simple answer to your question is, if somebody was not trying to solve this problem that you are talking about, the Temitope will probably not be working at Indicina right now, because that's exactly what they're trying to do. That's exactly what they're trying to do. They're saying that, all the loopholes that you have to climb. I remember applying for a commercial bank loan like 2 years ago. After 2 months of applying and they didn't get back, they now came and said they were ready. After that, they came back and said they were ready. The process of applying, sending them stuff, before the loan even came through, it took another 6 weeks, right? That's how painful it is. But we are now in an era where digital lenders tell you that in 5 minutes, you get a loan. What, companies like Indicina are doing is they are taking up a bunch of, metadata and, even more structured data, putting it together inside the basket, almost like you're playing Ludo and you shake the tin and you pour double six, right? And, you can get the loan. Because at the end of the day, if you look at it, that's what they're doing, right? And if, as a digital lender, I'm already taking the risk of giving a Nifemi a loan, or giving an Ife a loan, or giving a Temitope a loan, what difference does it make if I now even take it a step further to make the loan safer by saying, I'm not giving you money that you go and blow on Bet Niger, or money that you go and use to drink on Friday. I'm giving you money that you're using to buy something. I'm not giving you the money. I'm paying the person. And I'm almost certain that if you're buying TV, it's TV that you got. Whether you now go back and sell the TV for lower than the loan, that's a separate conversation entirely.
Exactly.
But at least, as far as profiling is concerned, I know that, okay, this person bought a TV of 250K, maybe is living larger than his means, no problem. Or, it also tells me this is, the person's taste or affordability.
Okay, so a lot has been said about Indicina. So Tobe, I want you to shed more light on that, since they are leading the pack in this credit risk thing, because it almost looks like they are digital babalawos, quote and unquote. So throw a lot of things into the mix it up, and then spit out a value and be like, yeah, you're safe. Give Ify the loan. I want to find out at Indicina, to what extent are your technologies advanced, to make this kind of decisioning possible? Do you employ machine learning or artificial intelligence or even deep learning? To the extent you can divulge, I know a lot of these things might be protected by IP and is your trade secret.
Right. Thank you, Nifemi, and thank you, Ify. So Nifemi mentioned, there are two aspects to our business currently. There is the part where we automate that lending process from beginning to end. In Nifemi's example, he reached out to the bank. They didn't get back to him until two months later, and then 6 weeks later, they wanted to then disburse the loan. We have a product that just, that allows any business really that has the capacity to offer credit to be able to set up a digital channel within a few days. And so you don't have to wait 2 months to hear back from the bank. You apply on your phone, on web, and that whole process is done within minutes. Now,
I'd like to interrupt you, sorry, because you said something very important, and it's very also important as well that we capture the value that your company is creating. So are you saying that Ify, as a business, I have a database of some sorts? Maybe I'm affiliated to markets in Lagos, Balogun, My 12, and the rest of the other markets, that if I bring my data source to Indicina, that they can layer on custom or bespoke algorithms for me to make decisions. Is that what you're saying?
Yes, if you do have the data. So there are for our credit models, we employ machine learning for our credit models. There are two types of data that we would look at. Is it your data, first party data? Is it your own data? Have you been doing this? Have you been giving out credit for a while and you have like a whole, years of data that we can work with? Or are you giving us third-party data? If it's your data, we look at things like, the customer themselves. What are the demographics, age, location, income, and then we look at the data on the actual loans that you've been giving out before. What are the repayment schedules? Who has been repaying? So we get all that data, and with that we can build, a risk model for you. Really, what a risk model will just do is an admissions model that allows you to determine the creditworthiness of these applicants. Now, in case you don't have that much data, but you are willing to lend, that's when you can give us data from third parties, like the bank statements that you can get. You can send, you can give us bank statements, or even the credit bureau data, or even the telco data. And with that, for example, we can build some sort of rule-based expert scorecard for you that still helps you to discriminate against potential defaulters. We also build affordability models based off these transactions. Basically, what we're saying is, this person is good for credit, right? Because you have a risk model. But we then say, aside from the person being good for the credit, this is what this person should be able to afford based on what we see from that transaction data that you have given us.
That's interesting. Thank you. So I'm taking the conversation back, and by the way, kudos to Indicina. So I'm taking the conversation back to the players. There was a before type kind of credit, very, very safe. And there is a now where it looks like people are beginning to be more risk averse and exploring, different demographics in what we have. And I want to find out, it appears to me, correct me if I'm wrong, that the credit bureaus, three of them are being disrupted. How relevant are they to the to the evolution we are seeing in the credit infrastructure space, especially for the digital lenders? Nifemi, I'd like your thoughts on that.
Interesting, right? So I think first things first is regulation plays a huge role in their relevance, to be fair, right? So as a lender today, at least as long as you're a central bank regulated lender, you're expected to report every loan to at least two of the three credit bureaus, right? And I think before now, all was well in paradise when it was brick and mortar, submit a long application form. They were up to speed at that time. But I do think that in more recent years, you know, for as candid as possible, I think the credit bureaus have had to play catch up to the technology advancements that have entered the lending space in Nigeria. So as opposed to them now being, more on top of the situation, they're now having to catch up with, a lot of the digital lenders and their pace and, the faster turnaround time. I gave the example of, 6 weeks to get a loan approved, right? Back then, if you were updating your credit records once a month, if it's taking 6 weeks to approve a loan, it's fine. There's no problem, right? But now it's taking 5 minutes. So if you're updating your record once a month, like that's trouble, right? And hopefully they get to catch up a lot faster than what they have right now. So yes, they are a crucial player because of regulation, but they can be doing a lot better than they are right now.
Thank you for that view. So we've been talking a lot about what takes place to give somebody a loan, a lot of decisioning, and all that, and profiling. And it looks like that's what a lot of people are focused on. A lot is not being said about the default rate and whether these monies are being paid back or not. And I want us to discuss that quickly, even as we are looking to end this session. So what's the default rate like? These things that we don't normally hear of. Anybody's like, oh yeah, business is good. We got funding, but are the investors and investors happy? That's number one. And number two, to what extent did COVID affect people's capacity to pay as well as willingness to pay? Tope?
Yeah, so I think firstly, we can group risk risk appetite for lenders. There are broadly two groups. There are the traditional banks, both the commercial banks and the microfinance banks. And then there are the digital lenders. Traditional banks and microfinance banks, are generally more conservative. I think by regulation, they're expected to keep their portfolio at risk at around 5% or less. But I think digital lenders tend to take on more risk, and they have a larger risk appetite, and so they are open to taking higher default rates. Probably maybe up to 20% or thereabouts. But for COVID, yeah, definitely, it's world over. COVID really, caused a lot of job losses everywhere. And if somebody loses their job, propensity to default has just gone up. I think there was a study, I think published by, was it PwC or McKinsey sometime last year, about the risks to banks on COVID, and default was one of the things that was mentioned because it will affect their loan to or deposit to loan ratio or something like that. And just recently UNDP also published that about 20% of all of employable Nigerians lost their jobs as a result of COVID. And this is not just those in regular paid employment. We're talking of those who as well, small businesses as well. And so while I don't have absolute values for what the default rate is, but because my at Indocina, lenders come to us to use our products. So we hear the anecdotes. A lender is saying, well, they have customers coming back to them to ask to restructure their loans because they no longer have the capacity to be able to pay what they were expected to repay at a certain time. So we've heard those stories, and while it's a sad thing, I do think that credit is still the growth engine of, is still capable of growth in Nigeria and everywhere in the world. And, we should continue to look at ways to expand and democratize credit actually for everyone.
Thank you. I'll go, I want to turn that question around a little bit, Nifemi, and ask, again, because we are trying to provide insight into the credit business in Nigeria. And a lot of people see what the glory is or what the front end is, and they're not aware of what's happening at the back end. So could you help me unpack the cost of offering credits, especially from a Nigerian perspective? I would like to find out.
So I think first things first is credit is expensive, right? To even give it out, right? So I think for financial institutions, it's relatively cheaper, and it sort of gives them the advantage, and that's why you find that they will always offer the best rates, or their rates are like affordable, or they make sense. Even the optics of the rates make sense. For a commercial bank, they have deposits. We all keep our money with them. They have direct plugins to the likes of NIBS, so they can pull BVN, they can pull bank statements. They don't need to pay for some of the things that digital lenders have to pay for. So imagine a lender that has maybe a finance company license or even a state lender's license. For every loan that they need to disburse, they're making calls to the credit bureau, say maybe at as high as 200 naira per call. God help you, the call say if there is not sufficient information inside, or it comes back that the person has never taken a loan before. You've made the call, you pay that 200 naira. For instance, you're checking the BVN, whoever it is you're using, maybe Smile ID, maybe Doja, maybe you verify. There's a cost somewhere between 50 to 100 naira just to check their BVN and be sure that this person is solid. You are going to meet, say, my bank statement or an Okra or a Mono. You're calling, bank statements. You are paying another between 50, or maybe between 30 to 70 naira, depending on your volumes and all that. At the point of disbursement, because you are not a financial institution, again, you're meeting a Paystack or a Flutterwave to handle disbursement for you. Disbursement can go as high as 50 naira to get credit to those people's account. And when it's time to even collect the loan back, you're being charged maybe 1% per repayment to get the loans back. And that's aside, cost of regular SMSs that you need to send. Reminder, your loan will expire in 7 days. In 3 days again, your loan will be due in 3 days, or your loan is due today. Those are SMSs.
And then infrastructure costs as well.
Yeah,
we're not talking about server costs.
We've not even gotten there. There's now the customer service people that need to call them to say, oh, are you having any issues with your loan, or what's okay, we saw that you just repaid your loan. What can we do to serve you better? All those things. Then when we now even come to the in-house cost, right? You are looking at cost of engineers, PMs, operations people. If you're a digital lender, you're paying through your notes and your teeth to, data scientists, decision scientists, machine learning engineers. These are disciplines that you won't even readily find in Nigeria. So, you're paying in FX. God help you, you are raising equity in dollar, or you're even raising debt in dollar to disburse these loans, right? That means there's a cost of fund, right? Which can be from as little as, say, 2% per loan to as high as maybe even 5 or 7%. You're raising equity in dollar, you're giving loan in naira, you are collecting the money back in naira. Maybe you collected the debt equity when naira was 365, and you are paying it back as of now. Like it's expensive, and that's why you see that. Yeah.
No, I'm just exclaiming at everything you said now. So
exactly. And you can't tell the person that gave you money that dollar has gone up in your country. So at the end of the day, right, that sort of helps you to see why the rates that digital lenders are giving a lot of them are actually really nice. They're, just making a little margin there for profits at the end of the day, because after disbursing in a chunk, they still need to make room for the default rate, like Dr. had mentioned earlier. So for them, they can even be more accommodating, say 10-15%, right? But they still know that, okay, if we give out 100 loans today, 10 of them are not coming back. And so they have to adjust their rates in a way that even if it's only 90 that pays back, it covers cost and they're still able to make some money. So
that is scary. So I 4 points or 4 major blocks. So the spending money to make a decision, spending money to disburse after you've made a decision, spending money to recoup or to repay, and if you default, you spend another money to get the people that will recover the loans for you, and then spending money to run your business. God help you, you don't understand regulations and you're not in compliance, then you also spend money if you're hit with any penalties from compliance. This is, it's crazy. I don't have any other word to use and describe it. So there are various things that have started off like this and they became much better. They're almost commoditized now, like switching. Do you think that with collaboration, there are many players now, doing different things. Do you think that with collaboration, the cost of offering credits would ever reduce in Nigeria, make it more profitable to offer people loans? Tope, what do you think?
Yeah, Nifemi, highlighted along the entire value chain, where there's a lot of where businesses or lenders have to spend. I think just generally, the way, like he mentioned, for example, that banks have access to NIBs to be able to pull statements directly. They have access to BVN to be able to get BVNs without having to pay some other person. I think if there are ways to make those kind of things more accessible to even the digital lenders, to allow them to be able to reduce the cost of lending, they to really go a long way to help them. I know that with credit bureaus as well, of course, there's a cost to pulling a credit bureau report. And not to slide the credit bureau guys, Nifemi said they're playing catch up, and truly they're trying to catch up. They've started to create, smaller reports that are not as data rich, but help to do quick decision making as well. So they have some smaller reports that are a bit cheaper, that digital lenders can use to make credit decisions. In the digital lending space, I think recently some digital lenders decided to come together to collaborate on a sort of blacklist that will allow them share data about the defaulters in their space. I know it would be very useful if Quick Cash is able to get data on Quick Loan to know that customer A is already has a loan there and is taking this amount and has defaulted, on this amount very quickly via API. It will go a long way to reduce the cost. Because even with this blacklist, one of the things that they're doing is they're incentivizing the digital lenders to give data. Because every time you give data and that data is used by another lender, you get to earn some money. So that incentivizes you to want to give your data for other lenders to be able to make use of. So that's one way that I see that collaboration can help to reduce the cost of the lending business.
That's interesting. Ifemi, do you have thoughts on that, please? Because this cost needs to come down.
Oh yeah, I definitely agree. And again, nothing is impossible, right? I remember some years back when the Jollowe used to have this is beginning of the year, what's it called, postulations or predictions. I remember when he said transfers will come to zero, and I was like, are you bonkers? I think at the time transfers were still like 50 naira, right? But hey, it didn't even take long. I think as of 2 years ago, we had started to see it with the likes of Kuda, Opay, that transfers can actually be zero, right? And I think that lending can also,
Is it
you
still
know,
like that?
oh yeah, a lot of people still do. Kuda will give you 25 free, Carbon gives you 30 free. A lot of people are still doing free. Some are doing 10 naira. So yeah, well, at least to a large extent, somebody is a prophet wherever he is, right? And I feel like for lending, we can also get to that point where, you know, imagine maybe not the credit bureaus, right? Or it could even still be them, right? Imagine the credit bureaus came together to partner with an Indicina, and all the other data sources that we are going to pay for is something that you can get from the credit bureau, right? Or from one single source of truth. It considerably drops down the cost. Or imagine, the biggest cost from what I mentioned earlier was probably the credit bureau checks. So imagine there was even some sort of incentivization for lenders to say that, you know what, for every time you give us 1,000 records of your lending, you get, half the price for the next 1,000 records that you are calling from us. There are a lot of simple, small wins that we can do. Again, why are we spending so much to retrieve DVN, for crying out loud? It's like saying you want to check for somebody's social security number and they're charging you $1 or 50 cents. Like, some of these things are, forgive me, ludicrous, right? We are making money from checking BVN, something that is like charging for account number lookup, right? Which some banks used to do at some point. I don't know if they are still doing it, but let's not go there. But again, these things,
Okay.
there's no cost. It's not costing anybody anything. Maybe yes, support or infrastructure, but this cost can come down. I don't see why BVN check should be more than 5 naira in this country. Like, it's pointless. Checking statements. What if the banks, open banking becomes a thing, and the banks actually open up their APIs directly and say, you know what, forget, come and check this thing. But if you lend to our customer, there's a share margin, or in fact, maybe the open APIs can include statements and direct debits, where, okay, if you give them loan, we can now make money from the direct debit. There are a lot of things that we can be exploring for competition, for to drop down this pricing. But collaboration is at the heart of it, where the whole ecosystem comes together to see that this is a win-win. It's not fintechs versus the banks. It's not digital lenders versus traditional lenders. It's just, Nigerians trying to make Nigeria a better place for every Nigerian.
Thank you very much for that very passionate piece you just delivered. And it's true. And I trust in Nigerians, especially in Nigerian fintech's ability to innovate and innovate and, crash these things down by forcing incumbents or other people to think differently. So final thoughts about other possible ways that we can offer less risky credit, or even ways you can begin to pull data sources together to make more informed decisions. Because I think the cost is, first of all, because you're trying to find out as accurately as possible if somebody would default or not. So what are your thoughts around, some people have said, profile people's social media data. So if he's on social media, on Twitter, and on Monday she's asking for urgent 2K, and on Friday she's asking for urgent 2K, and then on Saturday she posts a picture after asking for urgent 2K, where she's the remain somewhere, right? So from these various data points, you can quickly say this girl, she's not very stable. Apart from that, another IFI has also been working for a while and has amassed a lot of data, a lot of money in her pension, and that data has been latent and passive somewhere for a while. What are your thoughts around these two kind of data points, and even other alternative data points that we might not be exploring? So I'll hear from you, Tokbe, I'll hear from you, Nifemi, afterwards, and then we'll close the session.
Yeah, so I think firstly, social media data, I know that there was a social lender that started that did something around social media data. I think it was your Facebook social graph. I don't really have much information about how that went, but if I'm not sure social media data is very trustworthy to be able to make be able to make lending decisions. I think if one were to look at data to make a lending decision, you want to look at maybe even telco data, for example, because the amount of money that you load on your phone and how frequently you load that phone with that amount can help to tell how much you have to spend. Of course, the holy grail is getting access to the person's financial data across all bank accounts. That's the holy grail. We operate multiple bank accounts. That's the holy grail. People get access to that. That's what every lender probably wants. And it's possible to, you can build models around even the telco data. At Indocina, we're trying to explore partnerships with a couple of telcos to see if we can build models around that. You mentioned pension data as well. I think that's a good source of data. I don't know if Nifemi has thoughts around pension, how to use pension data.
Okay, so Nifemi, let's hear from you. He said he doesn't believe, Tobai said he doesn't believe that social data is any good, but employers and people at the embassy are asking for your social media data now because people tweet without thinking about it or like things without, very conscious effort. Why is it not a representation of your ability, your willingness to pay? Your thoughts, please.
So I think it's a function of how you intend to use it, right? So maybe the use case, if he painted, may not be like the most ideal when it comes to assessing that data point and using that to make lending decision. So there's this platform that we were trying to integrate with when I was at Fairmoney. They're called Sion.io. I think they're somewhere in Europe. I can't remember which of the countries, but what they do is they check your social media footprints. All you need to do is pass an email or a phone number, and these guys will show you every social media platform that email is registered on. So it will show you the person's LinkedIn, Facebook, Skype. Like they have a rep, as long as that's the email you use there, and is one of the platforms that they support, they can get some information on it. So imagine you're applying for a loan. You say that you work at X place, and by the time they check, your LinkedIn is saying that you are not there, or you didn't update your LinkedIn. For them, it's a flag. So they use it more on a fraud check level for lenders, right? But it's a good thing. If you are calling phone number through their APIs, they will return things like your WhatsApp, whether you're on WhatsApp, whether you're on Telegram, the platforms that use phone number as unique identifier, right? And that's just one way to look at it. Things around whether you're trustworthy or not, pieces of that could come up from your, say, Twitter. If you are the kind of person that maybe you're always insulting somebody, all those kind of things. So maybe not things like your propensity to pay back or all that, but it could be indicative of behavioral things that could still be helpful when they're coming up with credit models. And as far as alternate data sources are concerned, I mentioned or you talked about pension, right? And I'm like, there's no reason why the PFAs that we have, with the amount of data that they're sitting on, should start to quote and unquote commoditize it, right? If I have 4 million naira sitting in my pension, it's easy to sort of, based on my monthly remittance from my employer, deduct how much I earn in a month, right? So it saves, if that one data source exists, it saves the stress of checking bank statements, jiggling it together to say what's my total inflow versus total outflow, because in one clean swoop, you have a clear cut number on my monthly earning. There's even partnering with established payroll platforms, people like Remitter, they already do something like that. Who are the other big payroll platforms? Bamboo HR has, quite the clientele in Nigeria. The likes of Seamless HR have quite the clientele in Nigeria. So, why aren't we talking to these people to say, if you are an employer on this platform, we can partner with lenders to give your, your staff salary backed loans, and straight off it cuts off. I don't need to check BVN. I don't need to check anything. All I'm waiting for is how much does this person earn? And in your API, you're telling me when he resumed. The day the person leaves, the HR platform already has that. So it tells me that this person has left. And what that also does is the moment you're able to drive down the cost of giving the loans, the lender can in good faith reduce the interest rates, because
Exactly.
for all intents and purposes, the loans are not as expensive as they were. And so there is absolutely no reason why they should still be, giving them at such high risk. Tokwe also mentioned telco data. At some point, maybe we will also start looking heavily into bill payments data. How much electricity do you buy?
I think we have lost Nifemi.
Ah,
Oh, your voice went off, but that's also a
okay.
little bit good because we are running out of time and then we need to close this. I
All
have so
right.
much more questions, written down here, but I'm watching the time and we stretched it beyond the time allocated already. So this has been very insightful. To everybody that is watching on YouTube, thank you very much for logging in. For the questions that we explored here and even the ones that have been unanswered, if you're in the payment log community, just log back into the community and look for the room that is titled Credit Infrastructure Room. And we're going to continue the conversation there. That's one of the advantages of being in the community. Thank you very much, Nifemi, for your time. Thank you very much, Temitope, for your time and for everything that you've highlighted that is happening at Woodcore and in the Sina. Thank you very much for all the insights that you've shared. And thank you to everyone. Special thank you to the payment log team. They put all this together and did all the behind the scenes sellotaping and everything to make this happen. Thank you very much. And have a good evening, everybody.
All right. Bye-bye.
Right. Thank you. Bye.
Bye.